You see the headlines all the time, right? Big, flashy numbers about huge stock market gains. It's easy to get excited. But that single number, it often hides a much more complicated story. So today, we're going to break down why your actual investment returns might be very, very different from what you see in the news.
And make no mistake, 2025 was, by all accounts, a fantastic year for U.S. stocks. The S&P 500 index, which is a huge benchmark for the market, posted a massive 18% total return. I mean, wow, that's an incredible result.
But here's the thing, is that the number that really matters to you? If you're an investor living outside the United States, did you actually see an 18% gain in your portfolio? The answer? Well, it might just surprise you.
So let's start with the simple case. For an investor holding US dollars, that 18% gain is exactly what it looks like. You put dollars in, you got 18% more dollars out. Simple, straightforward, and a very, very strong performance. Can't argue with that.
But, and this is a big but, the moment you step outside the US, the picture changes dramatically. You have to account for something we call the currency twist, and suddenly, that amazing return, it looks completely different.
Let's just put this side by side to really see it. For an investor in the US, it's a clear win, a great year. But for someone over in Europe, that 18% gain shrinks. A lot. So what's going on here? The stocks did great, sure, but the money they're priced in, that's a whole different story.
This is really a tale of two different returns, one for the US investor and a totally different one for pretty much everyone else. So let's dive in and unpack what caused this huge difference in 2025.
Okay, so what's the culprit? It all comes down to one thing: a weaker US dollar. When an investor from another country wants to convert their gains back into their home currency, a weaker dollar means those gains are simply worth less. It's as simple as that.
And you don't have to take my word for it, just look at this chart from JP Morgan Asset Management. It shows the impact perfectly. That tall bar on the left, that's our impressive 18% return in US dollars. But look what happens to the other bars. For investors using the British pound, the euro, or the Swiss franc, the actual return they saw was drastically lower.
Let's just zoom in on a specific example. If you're an investor in the UK, using British pounds, the dollar's weakness acted like a currency headwind. It literally blew against your returns, shaving off a full 6 percentage points. So that awesome 18% gain, it suddenly feels a lot more like 12.
And if you thought that was a big deal, wait till you see what happened to investors in the Eurozone. The effect was even more dramatic. That currency headwind was so strong, it wiped out a staggering 13%.
I mean, let that sink in for a second. That is a 13 percentage point reduction just from the currency movement. Imagine that. Your stocks gain 18%, but after you convert the money back home, your real return is only 5%. That's a massive difference, and it's caused entirely by the currency effect.
So this whole phenomenon has a name, of course. It's called the currency effect. It's the gain or loss you get when the value of the foreign currency your investment is in changes relative to your own home currency. It can be a tailwind, which is great, it boosts your returns, or, like we saw in 2025, it can be a serious headwind.
Okay, so that was 2025. You might be thinking, ancient history, right? Well, not so fast. Why is this so important to understand right now? Because it directly impacts what's expected for 2026. This isn't just a history lesson, it's a critical factor for the year ahead.
So here's the key piece of the puzzle. The big forecast for 2026 points to falling U.S. interest rates. And, as you probably know, interest rates are one of the biggest drivers of a currency's value.
Because of this, the forecast from JP Morgan is pretty blunt. They say, we see further room for USD weakness next year. That's about as clear a signal as you can get that the trend we saw in 2025 could be here to stay for a while.
So what does that mean for you? It means that currency headwind we've been talking about, the one that hit international investors so hard, it could absolutely be a major factor again in 2026. In a way, what happened last year might just have been a preview of what's to come.
All right, so after all that, let's boil this down. What's the most important thing to remember from all of this? Let's break down the key takeaways.
First off, remember that those big headline numbers, they don't tell the whole story, not even close. Second, currency movements can act as a huge headwind or tailwind for your investments. The weak US dollar in 2025 is the perfect, if painful, example of this. And that means, looking ahead, factoring in currency moves when you're planning for 2026 isn't just a good idea, it's absolutely critical.
And that really leaves us with one final, important question to think about. When you look at your own investments, when you plan your own strategy, is your portfolio truly prepared for these kinds of currency shifts? It's something every single global investor needs to be asking themselves.